Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to the Corny Good Evening Watch for February 6th, Friday. I'm analyst Jang Jita. Please remember to like, subscribe, and share for us. If you have any investment questions, feel free to leave a comment. If I don't have time to answer your questions today, I'll make sure to address them one by one in the next session. February has already finished its first week, and looking ahead, both the Taiwan and US stock markets will be trading for another week next week. We're about to welcome the Lunar New Year, so everyone's really excited and getting ready for the holiday, right? No matter how your trading went over the past year, last year was the year of the snake, and now we've entered the year of the horse. So let me wish everyone a galloping success, lots of prosperity, and may wealth keep rolling in for you. After today's live stream, other teachers will be taking over the live stream next week. So let me give everyone a heads up. The next time we meet will probably be right around the Lunar New Year. This time, during the Lunar New Year, I'll be scheduled for February 20th, which happens to be the 4th day of the New Year. I'll be chatting with everyone about the market then. If there's enough time, I'll also touch on some educational topics. Maybe I'll talk about the Granville's 8 rules, or things like the Fibonacci ratios, and so on. Maybe during this more relaxed period over the new year, I'll spend some time chatting with everyone about some educational topics and interpreting the market. So just giving everyone a heads up in advance, and also wishing everyone an early Happy New Year, since the next time we meet will be on February 20th, the 4th day of the Lunar New Year. Alright everyone, good evening, hello to you all. It's Friday and I'm really happy. Finally, it's time for a break. Finally, a holiday. Every time Friday comes around, I'm in an especially good mood. I'm sure that after a busy week, everyone is also welcoming the weekend with a really cheerful and relaxed mindset. Alright, so good evening to Hui, and also good evening to Madaizi, good evening to Yulon Gi, good evening to Anna Ya as well. And who is this? Oh, it's Flying Fish. Hello, Flying Fish. Xiaomao Lu, Banana Fragrance. Hey, good evening to the staff too. Kokuli, good evening to you as well. Michelin, same here. Even though your name is written as Lin Kimin, I'm guessing it's actually Michelin. Good evening, Michelin. And also 6PCP728570P6. I'll answer your question from yesterday in a bit. I followed up on that Light Night company, the one that does fiber optics, and I'll give you an update on that. Good evening to Caesar as well. Good night, good night. Hello, everyone. I think everyone should be online by now. Okay, so let's start by talking about today's investment highlights. After we go over the investment highlights, if you enjoy the teaching, anyway, we'll wrap up, and then on the 4th day of the Lunar New Year, we'll continue. So if you have time during the new year, feel free to join the class and listen in. All right, because during the new year period, I'll only be working that one day, just that one day. The rest of the time, everyone should try to take a break and enjoy the holiday. As for the other days or on New Year's Eve, this year's New Year's Eve happens to fall on February 16th. I'll just say goodnight to the group that day, no live stream. Since February 16th is New Year's Eve and President's Day, group activities are paused. Then, for the first 4 days of the new year, 4 teachers will take turns being with you. We'll be sending New Year's greetings and talking about the market trends, okay? Erwin Chain, good night, good night. All right, Happy New Year, Happy New Year. Hope everyone makes money. Now, let's get started. For the investment focus section, the first point is cooling down. Cooling down too much, as always, is pointless. By cooling down too much, I mean like we saw yesterday in the economic data, especially the employment market data, whether it's the JOLTS job openings or we're talking about, the Challenger job cuts report and other indicators all showing a significant cooling off, a sharp weakening in the job market. Now, of course, this will encourage the Fed to cut interest rates. The number of rate cuts and how aggressively they cut will definitely increase because the economic data isn't looking good. Conversely, the market worries the economy is heading toward a recession. I'll explain. Are we really in a recession? And how should we interpret this data? Is a downturn inevitable? From the Fed's view, this data supports more rate cuts. It's all beta, meaning the White House's actions were for nothing. First, the US-China trade war shows these topics are like bland food, hard to swallow but a waste to toss. Take the Feta H200 chip. Supply rumors keep shifting and strict controls make it a waste of time. The Ukraine, US, Europe trilateral talks are similarly pointless, just running around for nothing. So what exactly is this meeting about? Just like we talked about yesterday, the things they're discussing are basically irrelevant and don't address the real issues. So what are the actual geopolitical risks we should be paying attention to? And during the New Year period, what are the key points everyone should be watching? Tonight's show will also give you a brief review of these topics. On the industry side, pressure is mounting as company financial reports reach a critical stage. Most have beaten market expectations, but capital expenditures saw a significant upward revision. For the seven giants, Meta, Microsoft, Amazon, and Google, spending has doubled year over year. Because these costs are so high, the market worries this spending won't generate short-term returns, causing notable concern. Despite solid fundamentals, the stock price dropped significantly. So how should we react? I'll analyze this in Amazon's earnings report. Also, Bitcoin-linked MicroStrategy's report came out, and it was terrible. The price plummeted from over $400 to just over $100 now. It's dropped almost 75%. Is it possible to try bottom fishing and catch a rebound? Tonight, I'll go through all of this and analyze it for everyone. Okay, good evening, everyone. It feels like with the holidays, something's missing. My favorite stocks. I feel like I've lost my backbone. I really like it when the teacher says, "Don't worry." We have a lot of teachers now. Really, we have a lot of teachers. They'll all talk to everyone about this. How exactly should we look at the market? Good evening to X-Fu and Amy Lee as well. Let me just briefly share with everyone. Actually, every teacher in our group, whether it's in the morning group or the morning coach show with Mr. Fan, they all share. Mr. Fan show covers everything. He talks about the general manager's perspective, US stocks, Taiwan stocks, and even European stocks. Basically, any stock market in the world that's being traded, he talks about it. He covers everything in 30 minutes, which is impossible for most since his daily briefings often exceed 100 pages. I don't know how he condenses that much into a short talk. If I presented 100 pages, it would take me 2 hours, but he just distills the essence. So, for our good night segment, originally, when we watched this live streaming teacher, it was kind of like teacher Dong Yacheng, right? Then maybe there's the Chinese teacher and also teacher Peng Rui, Peng Rui, and so on. We take turns with each other. Every teacher has their own area of expertise. For example, some teachers are really strong in macroeconomics, some are really good at international topics. That's different. Some teachers might have a bit of an edge when it comes to talking about Taiwan stocks. As for me, I just dabble a little bit here and there, but most of the time, I tend to share things with everyone in a simpler way. If you ask me to go deeper, I really can't, because there isn't enough time and I can't do too much in-depth analysis. So usually, I just chat with everyone about the market in a conversational way. Every teacher has their own strengths and everyone can learn from each other. I think everyone should try to learn more, because each teacher has their own area of expertise, you know? All right, good night, Melissa. Okay, yeah, that's right. President Fan is also great. Everyone is really good. Yeah. So the main thing is for everyone to keep learning. That's the key. So for this part about investment highlights, let me just give everyone a brief introduction first. The main focus includes economic data, so let's start by reviewing that together. Yesterday, why the US dollar and stocks dropped was 2 data points. First, the Challenger job cuts report. The previous figure was 35,000, but yesterday it hit nearly 110,000, almost 4 times more. So people are worried, like, wow, all these companies are laying off employees, and if the layoffs keep increasing, normally, if there are just occasional layoffs, at most we might say the job market's a bit weak or sluggish. But when there are massive layoffs, bigger problems start to show up. Maybe it's because the AI industry is booming and it's replacing a lot of jobs, whether it's customer service, data entry, or even software engineers and translators. They're all being replaced. As companies adopt AI, they're also cutting jobs. That's why layoffs quadrupled from 35,500 to nearly 110,000. This is exactly why people worry about mass layoffs. The people who are laid off might end up cutting back on their spending. If this situation keeps getting worse with unemployment rates and the number of unemployed people rising, then the driving force behind US economic consumption could lose its support. But there's no need to be overly pessimistic, because in the most recent rounds of economic data, whether it's GDP, US consumer spending, or personal expenditures, the numbers have all been quite strong. In fact, they're still very strong. The current US economy remains extremely robust, and consumer spending hasn't declined. It's just that everyone should pay a bit of attention to the slight increase in layoffs. If the number rises too much, if the increase is significant, maybe it could impact the next quarter or even the next 2 or 3 months. And then as for GDP or the overall economic situation, maybe it could be affected or impacted, but if you ask whether the most recent data is really that bad, right now it isn't. Just keep this concern about the number of corporate layoffs in mind for now. Another thing, which is also something we call a direct indicator, job openings. In December, the number of job openings in the US, according to the JOLTS report, also dropped from 7.146 million to 6.54 million. So job openings decreased by about 600,000. So now these two numbers show that the number of layoffs is increasing while the number of positions companies are hiring for is decreasing. In simple terms, not only are companies cutting some positions, but on top of that, they're also actively laying people off. In other words, not only are there fewer positions, but there are also layoffs. So with such a significant reduction, the market is weakening, and as the market gradually interprets this, there's concern that it might affect consumer spending or even cause the economy to shift from growth to recession. That's the worry. That's why the US stock market had such a big pullback yesterday. But on the flip side, it's two sides of the same coin. The other side is that the job market is cooling off significantly. We aren't in a major recession or crash yet. To be clear, one data point doesn't mean a recession starts tomorrow. It won't happen that fast, so don't be overly pessimistic. It's just that in the very short term, the way the market interprets this data can cause some concerns. First, the stock market is already at historic highs, and many tech stocks have extremely high capital expenditures. On top of that, there's suddenly news about a significant cooling in the job market, so people start to worry that the economy might be heading toward a recession. That's all it is. But as I said, there are two sides to every coin. Relatively speaking, the Fed will be more proactive with monetary policy, like cutting interest rates to support the job market. So it's really two sides of the same thing. So what should everyone pay attention to tonight? Besides looking at the job market data, we also need to keep an eye on changes in inflation. When it comes to inflation data, apart from tracking the three key economic indicators, CPI, PPI, and PCE, it's also worth occasionally checking the preliminary values of the US 1-year and 5-year inflation expectations. Either the 1-year or 5-year figure is fine. This data reflects the market sentiment. Also, just to add, the non-farm payroll numbers that were originally scheduled to be released today will be postponed to next week, February 11th, because the US government was shut down for 4 days. So just a reminder for everyone, the non-farm payroll numbers and the unemployment rate figures will not be released today. They won't be released today. Instead, they'll be postponed to next week, February 11th. Also, since we mentioned CPI, the Consumer Price Index, which is closely related to inflation, this data will also be delayed and will only be released next week on February 13th. So on February 11th and February 13th, keep an eye on these two important data releases for further information. Now, going back to the US inflation expectations for February, both the 1-year and 5-year terms, the 1-year expectation is at 4%, which matches the forecast, and the 5-year expectation remains at 3.3%. So if we look at the trend in these inflation expectation figures, they're all moving downward, cooling off. In other words, even though Trump started a tariff war, the current inflation expectations have already cooled down from their previous peak of over 6%. As Trump keeps negotiating and reaching so-called trade agreements with various countries, whether it's a temporary truce with China or deals with Japan, South Korea, Taiwan, even Southeast Asian countries, and including India, there's been relatively good progress even with the European Union, except for Canada, which basically ignored him. Other countries have, for the most part, reached agreements to some extent. So under this kind of framework, the escalation of trade wars between the US and China, or between the US and other countries, will gradually slow down and even cool off. So inflation won't be like it was back in March or April of last year, when the announcement of reciprocal tariffs scared everyone to death, and inflation expectations even shot up to over 6%. Right now, we're not seeing that kind of situation. Based on the current 1-year and 5-year inflation expectations, things seem to be moving in a cooling direction. As long as inflation continues to cool down, what about the job market? It's also cooling off, but we don't want it to turn into a major crash. We don't want a major collapse. With the support of these two sets of data, the Federal Reserve still has a chance to cut interest rates once or twice in the second half of this year. If there are rate cuts, that's generally positive for both the stock market and the economy. So the economic data, short-term volatility is high and its impact is significant, but in the medium to long-term, Fed rate cuts support the stock market. At 11 p.m. tonight, watch the 1- and 5-year inflation expectations mentioned earlier. Michigan's Consumer Sentiment Index drops at 11 p.m. Previous was 56.4, expected to dip to 55, so watch for that tonight. We'll also preview the weekend ahead. All right, standing, good evening, 6314, good evening, long time no see, it's been a while, huh? Let me take a look. Hey, just now a student mentioned, someone said that some teachers treat this show as political commentary. Is that right? Well, everyone has their own stance anyway. You can just listen and see for yourself. It's like AI replacing labor is causing layoffs. Evening, asking about Taiwan, US, or other markets. Short term, indices are just pulling back after a big rise. It's a correction, not a bear market, so don't worry. 000, night. Ling, night. Preemptively not filling vacancies is a common practice among companies right now. That's correct. And this is also the case in Taiwan. Someone asked whether the outcome of the mayoral election in Takasaki will affect the Japanese stock market next week. Yes, it will. I'll give everyone more details about this in a bit, and I'll also talk about Takashisaki's mayoral race. All right, like I said, this is just how it is all over the world. Sometimes when you have a job vacancy, you just don't fill it. Especially now, with AI developing so rapidly, if AI can replace a lot of people's jobs and it can work 24 hours a day without needing a salary, then that's what companies will do. And it never complains about being tired, so of course, in the future, AI robots could end up replacing a lot of people's jobs. I'll talk more about this in a bit. Today, Anthropic released a new version of Claude, version 4.6. They're saying it's about AI replacing white-collar workers, AI taking over the white-collar class. It's pretty scary. I'll remind everyone later about how we should really look at this whole AI development thing. AI development is really a double-edged sword. It has its pros and cons. It all depends on how you respond to it, how you use it, how should I put it, how you make use of that tool. That's all I can really say for now. If there's time later, I'll add a bit more for everyone. All right, let me first answer that person's question. Yesterday, what was it called? 6B? Yeah, 6B. 6B asked yesterday about Lumentum Holdings. How was its outlook? This company is currently performing well, both in terms of stock price and fundamentals. The stock price is extremely strong, continuing to hit new highs, reaching $504. In the short term, its upward momentum is definitely still there. Let me first talk a bit about its main fundamentals. Strong fundamentals drive stock prices. And there's a clear story here. Light operates in US optical communications, covering fiber optics and lasers. And their clients include companies like Apple, Meta, and Google. In their most recent financial report released on February 3rd, they mentioned that thanks to the demand for high-speed optical communications and AI servers, basically the need for fiber optics and optical communications is just getting higher and higher. From 600G to 800G, and soon 1.6T. Speeds are climbing as AI needs massive data, where even a slight transmission lag matters. It ends up that when you're processing or transmitting data, it'll lag. So in the future, with AI requiring high power, high performance, and massive data processing, under these circumstances, it must have enough speed. Otherwise, just think about it. Ugh. Just imagine this. It's like, say, in the kitchen today. The cooking's really fast. You order fried rice, then fried noodles, then a bowl of soup, and the chefs in the kitchen are all busy, chopping and cooking, ready to give you soup when you ask or rice when you want it. But if the waiters or waitresses serving the food are slow, even if the soup is ready quickly, by 9, the 8 dishes and soup are ready. But the waiter moves so slowly that by the time the food reaches the tables, half an hour has already passed. When the full meal finally arrives, what happens? The food is cold, right? The quality drops. That's the issue with future AI. It's like dongpo pork, powerful and fast, all coming out at once. But even then, can it reach every user quickly? Can computers and servers handle the load? Transmission speeds must keep up. In the past, data was transmitted through copper wires, but now it's mostly fiber optics, and maybe in the future, it'll be what we call CPO, co-packaged optics, where photonic signals are used for transmission. Because light travels at the fastest speed, right? Light is the fastest, so it transmits by flashing on and off. When the light is on, that's a 1. When it's off, that's a 0. This kind of method is much, much faster than transmitting through copper wires or even regular fiber optics. So when we talk about this company, Light, in the future, with the demand for high-speed communication and AI servers, revenue grew 65% year over year, beating expectations for 6 straight quarters. Like hyped Taiwan photonic stocks, it has solid fundamentals and a great story. If you're in, keep holding. Use the 10-day moving average, the blue line, as short-term support. As long as it stays above that line, then there really isn't any major issue. So this is my response to Six's question yesterday about Light Company. Now, moving on to the next topic. Regarding the officials, let's talk about what a student just asked about. Japan, sparkling water, good night, sparkling water, good night, needing to hedge against allergies. Someone asked if it's necessary to hedge against allergies. I think you can hold your stocks through the new year. I personally think it's fine to hold your stocks through the new year. But just don't have too much of your portfolio held over the new year. Don't have too much held over the new year. I would generally suggest, if possible, try to keep your holdings for the new year below 50%, whether it's Taiwan stocks or not. That's the strategy for Taiwan stocks over the new year. US markets trade normally then, so it differs. For Taiwan stocks, I suggest holding 30 to 50% in stocks and the rest in cash. This provides cash to buy back in if prices drop after the holiday. At the very least, after the new year, if we look at it based on past historical trends, markets usually rise 10 days before New Year. This year, with the market closing February 11th, it typically climbs and often opens higher after the holiday. Short term, the odds of a higher close remain very strong. Should you hold much capital over the new year? Keep about 30 to 50%, since the post-holiday situation is uncertain. This 9 to 10 day break is quite long. If the market rises after the new year, you'll still have half your holdings to enjoy it. But if a black swan or gray rhino event occurs, more on those shortly, during the holiday, everyone needs to be cautious. At the very least, if that gray rhino does show up, you'll still have half your capital to hedge against the risk. So I think keeping it below half is relatively safer. Now, speaking of this, let's talk about the upcoming elections. Japan's general election is set to take place on Sunday, February 8th. And as for Sanaya Takaichi, this female prime minister is quite formidable. She really comes across as a tough character. As for Trump, he openly stated that he supports Sanai Takaichi continuing as prime minister and hopes her ruling party will win the election. He's looking forward to meeting with Takaichi at the White House on March 19th. Of course, it makes perfect sense for him to support the current prime minister. After all, she is still the current prime minister. No head of state from any country would come out and say, I don't support you, the current leader. I hope you lose the election and I want someone else to take over. That's just impossible. So from a standpoint of morality, courtesy, and international protocol, he will definitely say, I support the current prime minister to win the election. This is a reasonable and normal situation. On the other hand, Japan and the United States have also reached a certain level of trade agreement. The investment involved might be 500 billion, or maybe it's 350 billion or 500 billion US dollars. Anyway, it's a huge amount of money. And as a result, a lot of collaborations like those in semiconductors and such will set up factories in the US. So since Trump has already reached a certain level of understanding with Sanai Takaichi, and speaking of Takaichi-sane, who did she learn from? Who was her mentor? For example, like Ip Man, what's his name again? Because what's his name again? Who did he learn Wing Chun from? Was it Chan Wing-wai or who was it? So for Prime Minister Takaichi Sanai, who did she mainly inherit her political will from, passing it down in a direct line? Shinzo Abe. Shinzo Abe had a very good relationship with Trump, so she claims to be the successor personally chosen by Shinzo Abe. That's why Takaichi Sanai brings this up, and that's why she has a certain level of connection with Trump. A pretty good relationship, actually. So since everyone has already discussed this connection, and with this kind of good relationship, they've already negotiated this trade deal. So naturally, Trump wants to support Takaichi Sanai in this election. Of course, looking at it from another angle, let's say on February 8th, if by some stroke of bad luck a black swan event suddenly happens, meaning Takaichi Sanai wins, She wants to call for a new parliamentary election to secure a majority for her administration. If this election suddenly fails, then everyone needs to be cautious. This might not be a good thing for Japanese stocks or the yen, and it certainly wouldn't be positive for Fitch either. In fact, for the stock market, it could be interpreted more negatively. First, the political situation would become unstable. Second, if Takaichi continues to be elected, she would obviously carry on Abe Shinzo's policies of stimulating the economy and boosting growth, as well as focusing on national defense and military buildup. While this might be good for the economy, for the stock market, the outlook could be more... It's similar, but if Sanae Takaichi suddenly loses the election, then you should expect greater volatility, and it might even affect the Nikkei index. Neighboring countries like South Korea or the Taiwan stock market will more or less experience some unexpected shocks from uncertain factors, so everyone needs to be careful about this. On February 8th, in principle, I think Sanae Takaichi has a higher chance of winning a majority. Usually the odds are in her favor, but we can't completely rule out the possibility. Who knows if a black swan event might happen and Sanae Takaichi suddenly loses the election. If that does happen, then everyone just needs to pay a bit more attention. Okay, that's what I wanted to add about Japan. As for whether it's all for nothing, well, that's just how it is. According to Reuters, Trump told China's ByteDance that if they want to buy 32,000 H200 chips, that's fine, but they have to pay a 30% tariff up front. A 30% tariff would be about $300 million, which is actually quite a lot. So overall, this will increase ByteDance's costs. He also said that not only do you have to pay the 30% tariff up front, but you also have to undergo a US technology review and sign agreements stating you won't use the chips for military purposes or unauthorized supercomputing, along with a whole bunch of other restrictions. So what exactly are these restrictions? Will China's ByteDance really have to pay for this? Do they actually need to? I think there are still a lot of uncertainties right now. The current situation is that the US is willing to export H2 chips to China and is also willing to let AMD's MI308 chips be exported to China. That's true. But there are a lot of restrictions and limitations in the framework, and with so many restrictions, it might not actually be beneficial for either Nvidia or AMD. Because for the Chinese market, it's like you can see the food, but you can't eat it. And as for China itself, their authorities might want to support and assist their own domestic chip manufacturers. So under all these conditions, they might not necessarily want to use the H200 or the MI308 chips. That's why things are stuck right now. It's like you can see it, but you can't have it. So in my opinion, this whole thing is just a waste of time for both China and the US. That's just how it is. Does this really help Nvidia? From what I can see right now, it doesn't really help at all. Let's talk again if there are actually any substantial exports happening. Okay, so that's a brief supplement based on the related Reuters report. As for Canada announcing something about working with China to promote some kind of homegrown electric vehicle production or exports, and then restarting EV subsidies, just take note of it and move on, because it's Canada. Canada isn't getting along with the US right now, especially not with Trump. So of course Canada has to build alliances. It's like the saying goes, the enemy of my enemy is my friend. The enemy of my enemy is my friend. America's enemy is China, so for Canada, China's basically a friend. So that's why they're trying to get closer to China and form alliances. It's just like that. As for how future trade or the trade war will be coordinated, well, we'll just have to wait and see. As for India, it's pretty clear that they've already started moving in Trump's direction. We saw just a few days ago that they announced their tariffs would be lowered to 10%, 18%, and then today it was mentioned again that India is preparing to place a Boeing aircraft order worth as much as $80 billion. Of course, this is pretty favorable for Boeing's stock price. Anyway, when it comes to tariffs, each country is looking for ways to maximize their orders as quickly as possible. It really comes down to two things: how the tariff war can be turned into, let's say, import and export trade. Turning a trade deficit into a balance, there are two things the US can do most quickly. What's the first one? Buy airplanes? Since a single plane costs hundreds of millions or billions, buying them is fastest. Next is buying American AI chips. You either buy from Nvidia, AMD, or Intel. That's it. For large orders, who do you buy from? You buy Boeing airplanes. So whenever there's a trade war or when countries sign major trade agreements, which companies benefit the most? It's Nvidia, AMD, Boeing, and then there's Intel. Really, just looking at these four companies is enough. Let me say it again: Nvidia, AMD, Intel, and Boeing. These four are the main players when it comes to trade volume. A lot of times, whenever there's a negotiation or a deal being made, all four of these companies get a share of the benefits. That's the idea. Note this, the US 10-year Treasury yield dropped from 4.19 to 3.05, and expected rate cuts rose to 2.3 times. As discussed last night, cooling employment data drove this, leaving everyone wondering if the Fed will now cut rates aggressively. Economic data suggests 1 or 2 rate cuts this year. The US dollar index rose 0.02%, remaining in a weak, choppy rebound. Regarding geopolitical risks, the focus remains on Russia and Ukraine. So aren't Ukraine, Russia, and the US having talks? We mentioned yesterday that basically nothing substantial is going to come out of these talks. Why? Because the main issues just aren't getting resolved. First, what is Russia demanding? They're making demands of Ukraine. Ukraine is not allowed to join NATO, but Ukraine hasn't agreed to that either. Second, if there's a ceasefire, if the fighting stops, Europe, the US, and other Western countries can't have any military presence or strategic deployments in Ukraine to help with defense. That's not allowed, because that would basically be the same as joining NATO. Third, ceding territory for peace, wherever the fighting has reached, that land would belong to Russia. So before these 3 things are agreed upon, basically, there won't be any resolution. So, as expected, what was discussed yesterday was just about exchanging 157 prisoners of war each and other things like that. There was no progress on the issues of territory, ceasefire, politics, or security. Not at all, so everything was for nothing. All right, so next he said that there might be a trilateral meeting in the US soon. We'll just have to wait and see. But like I said, as long as those 3 things aren't agreed upon, as long as those 3 things aren't settled, there's no point paying attention to anything else. So Ukraine and Russia will just keep dragging things out. What I want to remind everyone is that during these past few days, the more important variable in terms of geopolitical risk is actually the situation between the US and Iran. By ye here, I mean Iran, not Iraq, okay? Iran, on February 6th, which is today, they're planning to hold some talks. What are they going to talk about? Things like the nuclear agreement, restrictions on uranium enrichment, and a whole bunch of other issues. Right now, it doesn't look like they're going to reach much of a consensus. At the moment, it really doesn't seem like there will be any significant agreement. And then, the US virtual embassy in Iran also said they're urging American citizens to leave Iran as soon as possible and to make preparations to evacuate on their own. Don't rely on the government to help you get out. So that's basically what it comes down to. Now, you might ask, will the US and Iran actually go to war? I can't say it's 100% certain that they will, but I also can't say there's only a 30% chance they won't. No, let me tell you, as things stand right now, I think there's about a 65% chance that war could break out. Why do I say there's a 60% chance? Just think about this. Right now, the USS Lincoln aircraft carrier from the US has already gone all the way to basically Iran's doorstep. On top of that, there are about 9 or 10 related warships that have also headed over there. So, you see, Trump went to great lengths to bring so many warships right to Iran's doorstep. Whether he wants to blockade the Strait of Hormuz or whatever else, the point is, if negotiations really fall through, it's possible they'll just launch a full-scale attack on Iran's nuclear facilities, and then it'll turn into a back-and-forth fight. It's possible things could turn out this way. If the talks don't go well, all of these forces might be unleashed at once, because the arrow is already on the bowstring and has to be fired. On the other hand, you have to consider Trump's past. What are Trump's experiences and habits? That's just how he is. He never sends so many warships over every time. Planes, cannons, and warships don't just go over there for no reason. If they do go, there's usually some kind of action involved. If there's no action at all, it's like you're just withdrawing your troops and heading home, which doesn't look good for your image. So why would you send so many warships and so much equipment over there for nothing? If you're sending 1 or 2 aircraft carriers over there, isn't that just a waste of time, a waste of all that fuel money? So to some extent, I think he might actually be planning to intimidate Iran or threaten Iran's nuclear facilities, and there's a good chance he'll take some kind of military action. These strikes might not necessarily make things much worse or escalate the situation, but I think they could serve as a warning to others or have a deterrent effect. But if things really go wrong, if the strikes don't go as planned, then what could happen? He'd have a justified reason to go to war. The US could argue, Iran, you refused to negotiate. Since 2015, you failed the nuclear deal, so striking you was justified. Plus, you've been suppressing protesters and ignoring human rights. My strike isn't just about nukes, but your disregard for rights, giving me a legitimate reason to act. It's possible that Trump would do something like this. Basically, I'm not attacking you for no reason. I have a perfectly legitimate cause. Otherwise, there wouldn't be so much support for me. So I think there's a 65% chance, something we can't ignore or carelessly dismiss, that there could be concerns about war breaking out. And if war really does break out, then the price of crude oil could very well shoot up again, really spike, because right now the 200-day moving average hasn't been broken. Ever since it climbed above the 200-day moving average in mid-January, it hasn't dropped below it. So right now, the whole market is probably watching to see what happens next. On February 6th, Trump and his team. Will the US and Iran actually reach a good agreement? If they do, the 200-day moving average will drop back down. But if they don't, and like I just said, if there's an incident that gives a legitimate reason for conflict, if a missile's launched, then oil prices could really shoot up. This kind of surge caused by geopolitical risk and uncertainty will of course increase the demand for safe haven assets like gold, and also put pressure on the stock market due to these uncertain factors. This kind of uncertainty will happen in the short term. We're talking about the short term here. These uncertainties will occur, so everyone still has to be careful and pay a bit more attention. Really, you can't ignore it. Some people say Russia fights while negotiating, right? That's exactly it. It's like, what is it? Young Chun? Is it the Young Chun legend or the Wu Mei master? I don't really know. Anyway, the way I see it, I only watched Ip Man. I don't even remember which episode, maybe the 4th or something like that. Oh, Chan Washin, or was it Chan Winghua? If I'm not mistaken, it's Chan Washin. Okay, fine. You were talking about hackers, and now we're talking about Chan Washin. All right, I don't really remember who it was either. I just know that the Ip Man played by Donnie Yen was really good. I think I watched every single episode. Which part of the financial report is the media optimistic about? Let me remind everyone of some good news regarding the financials. The financial reports are actually not a big deal right now. It just so happens that during the Chinese New Year period, there aren't any major financial reports. The next important one will be Nvidia's earnings report on February 26th. In between, there might be companies like ON Semiconductor or Coca-Cola, but those are not a big deal. They might affect some automotive semiconductors or consumer electronics, but the impact isn't significant. ON Semiconductor, Global Foundries, those are all fine. The market's doing great, which matters most. Of the 7 giants, 6 have already reported. Only Nvidia remains, reporting in late February. AI development follows the same trend. So what about AI development? Actually, these companies are under a lot of pressure to increase their capital expenditures. If you don't ramp up your capital spending, your neighbors, your competitors will. Take Amazon, for example. Why did Amazon's capital expenditure shoot up to $200 billion this time? $200 billion. That's an enormous amount. $200 billion? $200 billion? Yeah, their capital spending hit $200 billion. I don't even know how they came up with that number. It's extremely high. So high, it's honestly beyond my imagination. It's like everyone is just calling out their own numbers. Check these numbers. Meta projected $110 to $130 billion in capex this year. Yesterday, Google targeted $180 billion. Amazon alone plans to hit $200 billion. Without a big number, investors doubt your growth. Fewer orders mean lower targets. Otherwise, you just cap spending at $20 billion. That's because neighbors and competitors are shouting numbers like 130, 50, or 80 billion, each higher than the last. Without a respectable 200 billion, you just can't get away with it. If you announce too low, it's awkward because your spending sounds too low. Then the market will say, is it because you're not getting any orders? Is there a problem with your orders? That's why your capital expenditure is so low. But if you announce a really high capital expenditure, the market will also say you have a problem. Your costs are so high. How are you going to make that money back? So for these companies, no matter what number they announce, there's always an issue. If you announce a low number, people will look at you suspiciously, thinking you're not doing well. If you announce a high number, people will say you're taking on too much risk, that you're at risk of going into debt. It's a real headache. Even companies like Amazon face the same thing. Everyone is making announcements, everyone is expanding, but it's still the same old saying. Right now, there's no bubble in AI. AI isn't in a bubble at the moment. It's just that the current capital expenditures are huge, and in the short term, it's impossible to quickly switch tracks or immediately generate positive cash flow. That's why people are worried. But this kind of concern is actually a good thing. It at least allows stock prices to correct and pull back after big gains. Returning to a more reasonable investment price is actually a good thing in the medium to long term, in my opinion. For the medium to long term, correcting concerns about overvalued stock prices is very healthy. When prices pull back, it actually creates buying opportunities for good companies. Otherwise, if the price just keeps going up and up nonstop and the stock price keeps rising, that's not necessarily a good thing. If it keeps going up, should you chase it or not? It's weird to be unsure about buying at such a high price. Should you chase it? If you don't chase, then there's not enough momentum, and without enough momentum, the stock price will come down. So it's better to let it have a proper, healthy correction and adjustment. I think that's actually a plus for its healthy development going forward. Amazon's earnings report's the same way. As for the fourth quarter, Oracle, you don't even need to look at Oracle. That's a whole different issue. Oracle's problems are very different from the other tech giants. The tech giants have high capital expenditures, but at least their revenue and profits are still growing, so that's not the same. The difference is huge. Amazon's Q4 revenue met expectations at over $200 billion. EPS was $1.95, missing estimates. Cloud revenue grew 24% to $35.6 billion. Its growth lags Google and Microsoft, whose cloud divisions grew nearly 50% and 40% respectively. Full year 2025 revenue is projected at $720 billion. That's staggering. Annual revenue of $720 billion, or 21 trillion new Taiwan dollars, nearly matching Taiwan's entire GDP. Cloud revenue at $130 billion is also incredible, up 30% year over year. But he mentioned that because they keep increasing capital expenditures, their FCF, that is free cash flow, dropped from $38.2 billion in 2022 to $11.2 billion. But at least it's not as bad as Oracle, since Oracle's is negative. And negative $10 billion. Oracle's is negative $10 billion. But Amazon is still positive at $11.2 billion, so there's not a huge issue with cash flow. It's just a matter of more or less. What about the Q1 outlook? Amazon's forecast is strong at over $173.5 billion, up 11 to 15% year over year. The issue is the massive $200 billion capital expenditure. The market worries they're burning cash too fast with a long payback period, questioning the return timeline. This is the market's primary concern. To add more, Morgan Stanley estimates that for Google, whose capex we noted is between $175 billion and $185 billion, averaging $180 billion, this spending could drop their 2026 to 2027 free cash flow by 58% to 80%. That's a significant decline, and the core issue now. This is exactly what the market is worried about. This includes Microsoft as well. So we can only say that these top performers, they really have no choice but to invest, because everyone around them is investing too. They're already halfway in, so they have to keep going and keep working at it. As for whether there will be that many orders coming in afterward, for now it looks like there will be. Right now, market demand is still very strong. It's just that this strong demand might stretch out over the next 2 or 3 years, rather than being something where in the next 2 or 3 months, you can quickly recoup large capital expenditures and make a lot of money right away. This is something that the short-term investment market is less able to wait for. But if you really look at it over 2 to 3 years, the capital expenditures of these large companies will keep coming, and the profits will keep growing, becoming more widespread and more mature. This trend is absolutely certain, 100% certain. But the short-term pressure does exist in this market, so you can see that stock prices are under more pressure for this reason. As for Amazon, it dropped 4.42% yesterday. Watch this short-term uptrend line. It broke the 2.5-month trend starting last November. While it fell below the line, it fortunately landed right on the 200-day moving average. After the drop, it held. As long as the 200-day MA holds, we're fine. Just watch it for a few days. If the 200-day MA isn't broken, watch for a break back above this trend line to improve its outlook. As for the other company, it's really hit rock bottom. There's nowhere left to fall, and that's MicroStrategy. Now, MicroStrategy's revenue for the fourth quarter, $123 million. But what's really astonishing is their campaign, which reached as high as $12.4 billion, an extremely large amount. If you have any investment questions, just leave them on the message board. If I have time, I'll answer them. If not, I'll try to follow up with everyone after class. All right, Sketch, I won't be polite either. No need to be polite. No wonder my former company Corning turned out the way it did. Hector, I remember Corning was supposed to collaborate with Meta. Meta supposedly secured a portion of their production capacity. Can't remember exactly how much, maybe several $1 billion, or maybe it was a 10-year capacity deal. That's why Corning's stock price went up at the time. Japan is more obedient than South Korea. It does seem that way when you compare them. That's how it was. Now, let's take a look at this other one, Mistral. Micro. This company, MicroStrategy, what do you think about it? Do you know its EPS? Hey, EPS? I didn't get the numbers wrong. It had a net loss of $12.4 billion, and its EPS is negative $43. Negative $43. Not 43 new Taiwan dollars and not just $4.30. No, it's negative 43 US dollars. That's a huge loss. So what's the reason for such a big loss? Basically, this company's biggest asset is buying Bitcoin. So what does it do when it borrows money? It buys Bitcoin. So when it comes to Bitcoin, the main thing is that its holding cost keeps getting lower. As long as the price of Bitcoin keeps going up, the company's assets will keep increasing. That means the company's stock price and revenue and even the overall health of the company are all completely tied to Bitcoin. So if Bitcoin goes up, the stock price goes up too. If Bitcoin bottoms, its stock could plummet. The company lost $12.4 billion in Q4, over $400 billion TWD. It holds 713,000 Bitcoins, averaging $76,000. The average cost is $76,000. Right now, the price of Bitcoin, as I checked today, has dropped to around $63,000 to $65,000. Wow, and I don't know if it's dropped even further now. So just think about it. Their average cost is $76,000, and the current market price is about $65,000, which means they're losing $11,000 on every single Bitcoin. They have 710,000 Bitcoins, so at the very least, their unrealized losses on paper amount to as much as $8 billion US dollars. That's a huge amount. Oh, and then there's something like this NANAB ratio. Everyone can use this as a reference. It's the company's market cap divided by the market value of its Bitcoin holdings, which is 0.68. If this number is above 1, it's relatively safe. If it's below 1, it could force the company to sell its Bitcoin. Okay, so recently you can see that the price of Bitcoin has dropped again, right? It keeps dropping lower and lower. So why is this company losing so much money? Now, you might ask, can it survive in the future? Will it be able to hold on? After the tide goes out, who will be left swimming naked? We don't really know if it will be NSDR or Coinbase or Circle or maybe some other company that's swimming out there. We just don't know. But what I want to tell everyone is that this company's stock price, at least as of yesterday, had plunged 17%. The current trend is still very, very weak. Really, it's still very weak. In the short term, maybe there could be a rebound after such a big drop, but overall, you shouldn't chase it recklessly. That's because if the price trend of Bitcoin keeps going down, then the stock prices of these companies holding cryptocurrencies might not perform much better either. Yesterday, we talked about Circle, and then today there's NST and also Coinbase, even including, what's it called? Then there's Bullish. It recently went public at $40, but plummeted to around $8. After peaking on day one, it's been falling non-stop. That's brutal. Most companies dealing in virtual currencies are seeing their stocks crash similarly. So for now, it's better to avoid these kinds of stocks. They're not the mainstream stocks at this stage. Just set them aside for now. That's safer. Don't chase after them. Don't go after them blindly. Now, as for AI companies, are AI companies really, hey, smile, smile, hello, hello? Yeah, MicroStrategy. Want to get rich quick? You'll end up capsizing. That's really two sides of the same coin. If Bitcoin really goes up, MicroStrategy stock used to go up to over $400, almost $500. But then the stock price just kept falling, all the way down to a little over $100. Now, as for whether AI will actually replace humans, let me give everyone a simple conclusion. AI probably won't be able to completely replace humans in the short term, but who will it replace? It will replace people who don't know how to use AI. It will replace those who can't use AI. If you know how to make good use of AI, you might have some tools. You can write marketing reports, do some engineering coding, and also do some, including things like financial analysis and market commentary. You can use AI for all of that. All of this is free, and AI provides really, really great information. As long as you make good use of it, you can have AI gather relevant information, then turn that information into a presentation, a speech script, or even a guest interview format. Audio files too. AI can do all of that. The key point is that the things produced now aren't 100% accurate. As humans, it's our responsibility to have the patience, breadth, and depth of knowledge to double-check the results. So AI will help everyone save time and boost efficiency, but the content produced by AI right now isn't 100% accurate. From what I've seen so far, its error rate is still about 20%. At the moment, I think the error rate is around 20%. 80% of it is really useful, but 20% of the data is wrong. So you absolutely shouldn't assume that everything AI generates is 100% correct. Sometimes it makes mistakes, sometimes the percentages in the data are wrong, and some things are just made up out of thin air. They're simply incorrect. Then you have to scold it. You have to say, hey, the data you just gave me is wrong. You need to find it again. Then it'll say, oh, sorry, master, I'll help you look for it again. It was my mistake. I'll find it for you again. So for the next set of data, what should the correct number be? All right, but just because it apologizes to you, just because OpenAI's ChatGPT or Anthropic's Gemini says, oh, sorry, dear master, I found the wrong data, this is the correct one, you still shouldn't trust it completely. I've had times when it found the wrong information 2 or even 3 times in a row. It keeps telling you sorry, but the next time it finds information, it's still wrong. Sorry, still wrong. Sorry, still wrong. So in the end, I just gave up and answered my own questions and found the information myself. That's how accurate it is right now. As for Anthropic, they say that this new generation model, Claude 4.6, might in the future be able to quickly review company data, check a company's CIN system, supervise company documents, generate detailed financial analyses from market information, and so on. Blah, blah, a whole lot of things. It might even replace some of the current traditional information service industries. Oh, so it could replace them. But I think even if they're replaced, it doesn't necessarily mean they're completely finished. Not at all. I think these existing information companies and service industries will probably find other ways to survive. There will definitely be other ways for them to survive. It's not like they'll just disappear completely. Let me give you a simple example. In the past, AI often talked nonsense with a straight face. That's true. So everyone needs to have the ability to judge whether what it says is true or false when using it. 200 years ago, well, let's say 100 years ago, before Watt invented the steam engine, there were no cars, right? There were no trains either, honestly. What did people rely on? They relied on oxen and horses, right? If you wanted to travel far, you had to ride a horse. If you needed to carry heavy loads or use some kind of machinery, you probably could only use oxen or donkeys to pull the goods. Then, when the steam engine was invented, that's when cars came about, right? Trains also came about. This increased the number of people, improved efficiency, and boosted the amount of goods transported. So at that time, did horses and oxen become obsolete? No, horses and oxen didn't just disappear. It's not like just because cars, trains, and airplanes appeared, birds died out, and then horses disappeared and oxen too? No, there are still horses in this world. Why? Because you can still ride horses, they can still be used for sightseeing, you can still have horse racing. Oxen can still plow fields, ox carts are still a thing, and if nothing else, people still raise cattle for food. Right, you eat beef, though horse meat is less common, but beef is widely available and eaten. So what I want to say is, in every era, from the agricultural society to the industrial society, and now to the current technological and digital society, every period of industry, every stage of information or revolutionary change, there are always some industries that disappear, some that decline, and some that rise. So how do you navigate between those that are rising and those that are falling? Find that one. That turning point that lets you make a stunning transformation, that's extremely, extremely important. You have to make the necessary preparations. Where is the current trend heading? What should you do to improve your technical skills, to increase your abilities and expertise? Only then will you avoid being left behind every time. In the midst of these changes in our industry, you could get swept away by the tide. So don't be that horse that might get replaced by cars or trains. Or a mule, because there are also high-class horses, there are race horses, and a single racehorse can be worth millions. So if you started out as a horse, now that the industry is changing, can you become a racehorse? Of course you can. You can become an excellent racehorse, or even a legendary horse like Red Hair. Exactly. It all depends on how you improve your own skills during these changing times. So looking at the future of AI, I think that now, for example, Anthropic has already released version 4.6, and even GPT has reached version 5.3. There are more and more versions coming out. In the future, AI will definitely thrive, and the only people who will be replaced are those who don't know how to use AI. So remember this, make sure you keep it in mind. Anyway, at the end of this program, I'll remind everyone about these related things. It sounds very realistic, and while it's a heavy topic, it's also full of business opportunities. As for the US stock market before opening today, there should be a chance for a rebound. In pre-market trading, for example, SanDisk is up 7%. Bitcoin, which had been dropping nonstop before, and Coinbase, the Bitcoin exchange, also rebounded 6.15% in pre-market. Robinhood, which is a securities trading platform, is also up 5.7% before the market opens. And then there's Vista and other companies like that. Western Digital also surged 4% to 5% in pre-market trading. Companies in the memory sector like Micron, AMD, and Broadcom all rose by 3% to 4%. So the stocks that dropped yesterday will probably rebound today. On the downside, Molina Healthcare's earnings report fell short of expectations, causing its stock to plunge nearly 30% in pre-market trading, a really significant drop. As for Amazon, as noted, earnings weren't bad, profits were just slightly weaker. But massive capital expenditures have investors worried. Mirroring Google, Meta, and Microsoft, it's the same story. Amazon fell 8% pre-market. Meanwhile, First Solar, Sempra, and Williams saw small gains of 1 to 2%. Overall, today looks promising for semiconductors. Tech stocks might lead today, propping up the market, especially semiconductors and the Philly index. Why support the semiconductor index? Let's see. The Dow fell 1.2% yesterday, but stayed above its moving average, so there's no need to worry yet. The Nasdaq has fallen below the quarterly moving average, and the S&P has also dropped below its quarterly moving average. This is something to keep an eye on. A short-term pullback and consolidation period might be a bit extended. As for the Philadelphia Semiconductor Index, why do we say that today? With companies like Micron and other semiconductor firms rebounding, there's a good chance the Philly Semiconductor Index can hold up. It's because this rising wedge must not be broken. We've been telling everyone this since yesterday, and even the day before. We said this wedge shouldn't be broken. As long as it doesn't break, at least it won't turn into a short-term bearish trend, and there won't be any major problems. Right now, there's still the quarterly moving averages support below, and as for this rising wedge, it doesn't look like it's been effectively broken yet. So today, if companies like Micron or say WDC are rebounding, if all these semiconductor companies are still doing well, like Broadcom and Qualcomm are also rebounding, then maybe the semiconductor index, the SOX index, has a chance to keep holding above this rising wedge. Of course, that would also be good for the Taiwan stock market next week, giving it a chance to rebound again. So everyone can also keep an eye on how the SOX index moves. Now, as for the Magnificent Seven, it's the same story. They've pulled back to this red circled area. If they can hold at this red circled area, then there really isn't too much to worry about. Overall, looking at the big picture, regarding regional indices, through the first half, regardless of market moves, the Magnificent Seven will act as key confidence indicators and continue attracting investment. Honestly, smaller firms won't carry the market. They might not be able to hold it up, and even if they do, it might not last long. So in the future, the regional leaders will still be a key confidence indicator. All right? That's all for the group-related content, giving you the latest updates before the US stock market opens. When class is over, remember to like, subscribe, and share for us, okay? Also, just a reminder, Mr. Zheng's next class will be on February 20th, the 4th day of the Lunar New Year. So on the 4th day, we'll chat more about the market and some teaching content. Next time, we'll have a good talk again, all right? Wishing everyone smooth trading. Happy New Year to everyone. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.